So I'll just move quickly through this. Because of the risk, we're talking again about funds. So from a fund manager perspective, the disclosure obligations are broad. You are needing to disclose not just issues that we know exist. We're trying to anticipate regulation that could come about. We're trying to keep track of various moving parts, a very quick moving industry, and their supporting intermediaries. Fund administrators are the front line, and you've got your custodial features and the exchanges, and they're rapidly shifting, and that requires us in our disclosures to be very thorough, and of course the risks to be very high. The other recommendation that we have is with our investors to make sure that not only looking for investors that meet the qualified standard, but in some cases going above that. So exceeding the requirements of the law when deciding who can be involved in these type of funds, because it is so risky, it is so uncertain, and it requires such a high level of sophistication for understanding these vehicles, and they're not assets that are ready for mainstream and vulnerable investors. Major two issues I touch on lightly. Custody is the most pressing issue. You have custody, and then the other one is the exchanges. And for custody, the two issues that we really need to worry about, one is the custody rule. And the custody rule itself has requirements that really cannot be met, in our view, by traditional custodians that are trading assets that are considered securities. Now, there are Bitcoin, Ethereum, and other tokens that we know are presently not considered securities, and so they can fall outside that definition. But the issue is the ability to provide custody throughout the entire custodial process, meaning during the exchanges, during the exchange portion of the transaction. So yes, we have a number of cold wallet storage custodians that will take the asset, put them on a cold wallet, put them somewhere, lock them up. We have these tokens, encrypted passwords that are protected, but once you go and put them on the exchanges, now they're live again. These custodians cannot provide protection during that period. And another, I guess, more academic issue is, well, what happens if someone gets access to those encrypted passwords, regardless of how well they're protected? There's no, when the asset itself is a digital asset, then this presents a lot of concerns for liability. But right now there are two solutions. One, you've got your cold storage option. Two, you have exchanges such as Gemini, Coinbase, some others who are providing end-to-end so-called custody, where they're actually providing the custody during the live trading on the exchanges. The problem is these aren't, this would be hard to call those true qualified custodians. They have a lot of conflicts of interest. They suffer from the best execution rule issues, because you have the same clearing broker as the securities provider, as exchange, as owner of a large block of the investments. So just a lot of potential challenges there. Again, if you're in Bitcoin, they're outside of the definition of security. If you're in Ethereum, you're outside of that. There are some additional technological pieces happening. IBM, for example, announced that they're working with a company called Shuttle Holdings. They're a client of ours in another aspect of their business, but it's an ability to have a live wallet exchange, and that technology will slowly arrive. The other is as I mentioned, the exchange issues, and there are a lot of open questions, and among those issues are handling AML concerns, and we'll get to that in our next presentation. All right. Going through the regulatory pieces. So for a fund, we're regulated at two levels. You've got the advisor level regulation, and you have the fund level or the investor level regulation. So as the advisor, a fund manager is subject to the Investment Advisors Act if they are advising on securities. So for the top level, we care about the asset classification. If cryptocurrency is a security, then that subjects the fund to manager level regulation. And that requires, this is you get into custody issues. One of the biggest issues we have is the size that the fund can reach. For true cryptocurrency investments into assets that are considered securities, there's a $150 million cap. And once you exceed $150 million in the US, then that requires full SEC registration. And at that point, they would need to follow the custody rule. There are a handful, a very small number of funds that have in fact registered. 2016, Pantera Capital registered with the SEC. They have a bank custodian. They're operating very carefully. Most of my clients, we look at them hitting 150 and that's it, unless you're extremely cautious. And if you're Bitcoin only, or if you're a venture capital based group that doesn't need to worry about these custodial issues, you can get bigger. But that's a major challenge, and that's why you see a lot of these will hover right to close to that $150 million mark. So how do digital asset funds avoid regulation? There are essentially four ways to do it. First is invest solely in Bitcoin and Ethereum. Technically, if you're there, you are not investing in a security. So, top level regulation under the Investment Advisors Act, you're not considered an investment advisor. Therefore, you're not subject to the custody rule. They still would be a securities issuer under Regulation D, and that's pretty simple to deal with. But if they don't invest in anything but Bitcoin, they're okay. The other is the venture capital exemption. Right now, that's the hottest fund trend is venture capital, and it's been going since much of last year, and we continue to see a lot of the larger raises in the venture space. Next is the 150 million asset under management. That's where most of the funds are going to be. And then technically, there's a foreign private advisor exemption, very rarely used because it only allows a $25 million mark.
I will now briefly give you a look to Europe, you know, we have also in Europe licensing requirements, and the important part is they are unrelated to the asset qualification. It's just important to have a pooled asset, a pooled vehicle, and usually then the IFMD licensing requirement follows from that. So whether it's utility or a currency token is not important. We have size-based exemptions, and of course we have also activity-based exemptions. The one exemption that you could use, for instance, for feeder structures could be a securitization vehicle when you don't want to have discretion on the asset manager level, and then you can set up a Lux securitization structure, for instance, to feed a Cayman fund, or you can use in some member states also a kind of junior debt structures. I don't recommend you to do that because there's no stability in these structures. The IFMD is a proven way to do things that is a bit complicated in the beginning, but long-term stability is of course an asset when you want to build there. But maybe for small feeder structures, there are other ways to achieve the funding chain. We have two challenges, and that's valuation and custody. Under our fund rules, we have to give a value to the assets, and I gave you the uncertainty on the asset side. And of course, the manager is liable for giving the valuation. Valuation correctness doesn't necessarily require that the number is always right, but the method that leads to the number is right, okay? So you need to have a good method that requires all these type of factors, and you can imagine that this requires a certain degree of due diligence to go through these factors and really allocate the assets in a way that you can eventually come to a valuation. And the other thing is custody. John has said a lot of these things. The important part is that if you're an FMB, you need to have a securities firm or a bank to function as custodian, and you can imagine that not too many banks like that type of risk that they get there. Let me now move into a quick summary of what we said, and that may also be a nice takeaway and entry for Matthew to get into the next presentation. When you consider what we've said so far, we have a number of obstacles to a mature market, a market that institutional investors like. Institutional investors like to be in the market when they have a significant degree of legal certainty and they only bear the investment risk, rather than a lot of operational risks that we were just referring to, because operational risks can be priced only at very difficult processes. So what do we need? We need to remove the tech issues that we have here, and we have a resilience problem and a cybersecurity problem. The cybersecurity problem is prevalent in more or less all tech markets, but the tech resilience issue is real. Yeah, just think about, you don't know when you buy a token whether the underlying infrastructure is stable. And we have very simple examples like the hard fork of certain blockchains, or the programming bugs in DAOs where just the code is not stable. And this is of course something where really experts need to assess whether what they buy is stable from a tech perspective. That's an entirely different question than if you ask whether the cash flows from a firm are stable, or whether there's a certain prospect to sell the assets in the future. Yeah? So this is really important to bring your due diligence up to date, because a traditional financial due diligence is simply not enough, and you need here a tech due diligence in a way. We spoke about all the low disclosure quality, but inside the market, even if the asset side is stable, you have a lot of illicit behavior. You have a lot of pump and dump, wash trading, spoofing, all the stuff that we have on the stock exchanges you find again, but now in an unregulated sphere on all these crypto exchanges around the globe. And this is something where you again need to kind of develop a kind of mechanism to save your investment from that. And of course, when you don't rely so much on the exchanges and go in early stage, that may be one solution. The pricing inadequacy, of course, comes from the fact that there is yet a shortage of sophisticated traders. If you would have hundreds and hundreds of quant traders dealing on many exchanges, then the arbitrage would in minutes erase pricing differences. But right now we're not at that stage, and here we need a bit more trader sophistication. And with regard to the infrastructure, John has mentioned the custody issue, the exchange issues, but I would also add one more point, that there are few specialist administrators and transfer agents. You know, the administrator also must know what he's buying. And here I think it's a small club that gets larger and larger, but it's a slowly maturing market. And of course, some will burn their fingers on the way, and the more you learn, the better you are. Yeah, that's old lawyers' insight. Yeah, before you haven't done a lot of mistakes, you are not a good lawyer. So here, of course, we see the same problem. But I think we have an insufficient number of mainstream players, because those mainstream players have big pockets. They can somehow go into the market, and it would be desirable to have more exchanges, custodies, and banks in it to try out. But here is some signal of hope. We have certain limited exposures from larger players, and maybe that signals the time is right to think about this asset class, because right now it can signal opportunity to have these players coming in. But of course, the regulatory diversity is also something to consider. Some countries, for instance, qualify securities different than the US. But of course, you must be certain that your home country qualification is correct, because if you believe you have purchased an utility asset and relied on the non-securities advisor exemption, and eventually the SEC finds that unfortunately that token is a security, that this may infect your whole structure. Yeah? And so it's really crucial to engage in an own assessment of what you do there, rather than relying on the existing disclosures, because they are simply not reliable from the stuff that we've seen. Well, and here, of course, it's basically a bit stronger self-organization, but the upside is, of course, given that there are relatively few real experts in the market, there's a premium for experts. The premium for experts is the upside in such an immature market. If you really know what to do, if you rely on professional partners and have a good due diligence process, then there may be also an upside in that market. But as I said, it's not low-risk piece. It's not one of those things that you should say, well, it's a safe income. It is really something that you have to approach with caution, and with the communication that requires caution. That means your investors should know what they get. What are the takeaways? We have a number of profitable investment opportunities. Not all of them are direct exposures to tokens. Maybe the direct exposure to tokens is a very risky one when compared to others. Regardless of what you do, the whole fund setup must have an orientation towards the digital asset, and it's a bit of a variant of the ordinary type, so it's not a standard private equity fund or something. And consider these obstacles in your disclosures and your choice of intermediaries, and also in your own language when you stand in front of your investors. With that, thank you very much, and yeah, we'll stay together here for the rest of the day.